In this video, I want to talk about, how to track and analyze historical stock splits for investment insights. Companies do undertake what is called stock splits. And how do you analyze these events, for better investment decision making? Number one, understand why tracking stock split is useful. Why is stock split useful? So we identify growth trends. It identifies growth trends. Companies that frequently split their stocks often have a history of consistent growth in share value. So let's take a typical example of stock split. Maybe let's say a company stock is let's say $10. The company can have a stock split. Instead of the stock selling for $10 per share, it could now be selling for $5 per share. That stock split. So market perception, analyzing past splits help gauge how investors typically react to such events. All right. So if you had a single stock for $10, you may now have two stocks for $10. That's $5 each. This is called stock split. So how does it relate to sector insights? So comparing stock split across industries can reveal sector-specific growth pattern. It reveals, the growth pattern in specific sectors. Number two is tools to track, historical stock split. What tools do we use to track historical stock splits? Number one, consider financial websites. Use platforms like Google Finance, like Yahoo Finance, or Bloomberg to find split histories for specific companies. When you look at those channels, it will show you precisely, when companies undertook stock splits. You consider stock exchange records. So check the company profile, on stock exchange websites, which often list, historical splits. You may also access, company reports, review annual reports, or investor relations sections of company websites for split announcements. They are there. If you go to the investor relations section of company websites, you could come across news or data on historical stock splits. Number three, key metrics to analyze. What are the key metrics we do to analyze? Number one is in this case you analyze split frequency. Look at how often a company has split its stocks. Frequent splits may indicate sustained growth. As they grow, they split. As they grow, they split. As they grow, they split. So investors end up with more number of shares, and as these shares increase in value, you have an outsized return at the end of the day. So you also look at post-split price trend. That is, when they split their stocks, what is the share price thereafter? So analyze the stock performance after each split to determine how it impacted investor sentiments and market behavior. Whenever a company split the stocks, how do investors behave? Do they buy further? Does the stock drop? Does it increase in value? So you consider this factor. You also look at trading volume. Examine trading volume changes after the split, as it can indicate shifts in liquidity and investor interest. Immediately after the stock split is implemented, you analyze the trading volume. Each time there's a stock split, look at the trading volume. That will tell you an idea of how interested investors are in the stock. Number 4, please don't forget to subscribe to this channel if you've not done that, and like this video. It will encourage me a lot. Number 4 is steps to analyze historical splits. Steps to analyze historical splits. Number 1 is you compile data. Compile data. So create a timeline of company stock split, including dates, ratios, and pre and post split prices. The price before the split and the price after the split. And you also look at the ratio of the split. Number 2, evaluate patterns. Look for patterns in price growth before and after splits to identify potential growth trend. If if this is encouraging, that will help you to make decisions whenever there's a stock split on whether to buy more stocks, to hold, or even to sell their position, as the case may be. Number 3, compare with peers. Analyze whether similar companies in the same sector experience splits and how their performance compare to the one you're currently either invested in or analyzing. Number 4, assess fundamentals. Ensure the stock split aligns with solid fundamentals like revenue growth, and increase in earnings, increase in profitability. Does the splits correspond with the fundamentals of the company, or do they just split the stocks without any relation with how the fundamental performs? Number 5, use historical split for investment decisions. That's the ultimate. You use historical split to guide your current investment decisions. In this case, you identify growth candidates. Companies with a history of splits may continue to grow if backed by strong fundamentals. If fundamental remains very strong, company with a history of stock split will continue to split its stocks and will continue to grow. So you also gauge market sentiments. Understand how the market typically react to split in a specific sector or for a particular company. How does the market react whenever there's an announcement or implementation of a stock split? How does the market react? How do market participants react? So avoid overvalued stocks. Avoid overvalued stocks because be cautious actually. Be cautious, of stocks whose value is driven primarily by split announcement rather than business performance or fundamentals. Usually, is the value of the stock influenced by the announcement, or is it influenced by the underlying fundamentals? You need to answer that question. So tracking and analyzing historical stock splits can offer valuable insights, but they should always be considered alongside the company's overall fundamentals of financial health and should not be done in isolation